I'm going to,
Cool.
so they have this for afterwards. Okay, off you go, Joanne.
All right. So my name is Joanne. I've actually been part of Shell Hoop Group for the past 9 years. I've joined the Greenhouse and the Greenhouse initiatives for more than 2 years and a half. And I co-lead the Greenhouse with Rafi, who probably you know and you've met, and Benoit as well. My previous background was in finance, hence why I'm actually leading this crash course today with Marco. And what I've been doing for the past 2 years and a half is a lot of finance too. So I haven't forgotten everything that I've practiced and learned before. Don't worry. It was kind of refreshing for me to go and redo like all of these slides a little bit and like re-put myself into some of the things that I don't see anymore. But the way I'm trying to look at this session is really much more conversational. And I'll tell you a little bit more about it after Marco presents himself.
Hi everyone, my name is Marco. I'm part of the Shell Hoop Investments team. I've been in the company for about a year now, which is quite at the same time when our team was settled in. I'm currently leading our venture investments, so we're looking at exciting and new startups in the region and abroad. And I was very excited to join this, program just to be able to get a first step or first look into some exciting up-and-coming brands in the region and seeing if we can possibly have a future conversation in terms of investments or anything in that matter.
All right, so I'm gonna just share my screen very quickly. Just give me a moment. Let me know if you guys can see.
Yeah.
Is it working?
Yep.
Everybody can
Yeah,
see
we can
everything?
see it.
Cool. All right. So just before we start, we did a little survey to really understand where each and every one of you sit in terms of financial acumen, business planning, and investment or fundraising. And we've realized that a lot of you actually are very good in finance, which is good to know. And probably where we're going to steer the conversation is much more on financial business planning and the 3 years or 5 years to go, and how would you go about fundraising today. But of course, we need to start with a little bit of basics and foundation just to make sure that the conversation is rolling properly. We would definitely encourage you to jump in, ask questions, add comments, give a little bit of feedback of what you've seen in your own financials. It's all about like collaborating and sharing experiences, because definitely, even if we don't mention it, other people will benefit from what you are doing or how you're looking at it from your own perspective. So we will try to tailor-make our comments and the way we read a financial statement based on beauty brands or I think for Nude, a little bit more on the beauty/fashion brand. And really try to give you benchmarks that we look at in the group or as per our experience as well. So this is a conversation. Please don't take it as a presentation or a one-way stream. So please jump in whenever you feel like it and ask as many questions as you want. Okay, are we ready to start?
Woo!
All right, so let's make finance a little bit more cool and fun. That's what I've been trying to do for the past 9 years in the group. So hopefully in this session, we can do this a little bit more fun. So we're going to go through a quick financial statement overview, the income statement, balance sheet, and cash flow, which are the most important financial statements to be looking at when assessing your own company and your own metrics and KPIs. We will be looking at business KPIs, which are very important, not only for you to be tracking, but as well when you're fundraising to understand how an investor or a partner would be looking at your KPIs to understand the healthiness of your business. And by the end of the session, we'll be talking more about how would we use this to your advantage to raise capital externally. Okay. So of course, everybody knows the 3 financial statements, the income statement, the balance sheet, and the cash flow. It goes without saying that they have an increased relationship between each other. Anything you would do on an income statement will impact your balance sheet and your cash flow and vice versa. It's super important to think of it as all your decisions that you're taking on your business are reflected in your financial statements. any kind of decision that you would do, whether it's commercial agreements, whether it's something related to your supply chain, whether it's related to hiring of team members, will be reflected and will impact your financial statements. So it's super important that you have them well thought of, that you are actually reviewing them quite often, that whether you do them in-house or you do them outsourced, that you're actually sitting with your team, or you're doing them yourself, that you're actually reviewing these and taking a step back to understand what the numbers are telling you. Because sometimes we do see ourselves quite sitting into the details and maybe focusing on one way, which is a little bit more commercial, or focusing on the supply chain, that we sometimes forget to look at the whole picture of our financial healthiness. So that being said, we're going to start with the income statement, which is one of the major metrics to really, as simple as that, it shows, are you profitable or not in a period of time? So it's important that the way we look at a period of time is, it could be monthly, it could be quarterly, and it can be yearly. So you will be able, or you should be able to look at them in these three metrics. The reason why is because on a month on its own will tell you just very limited information. But when you look at it on a quarterly basis, it fits a little bit more with seasonality. And when you look at it at a year basis, it really takes together everything that can happen in a year, not only for you, but for your clients, and for whether they are B2B or B2C. So an income statement on its own just gives you one information if you read it alone and at face value. It tells you if you're making money or not. That's why it's super important to look at it versus a budget, versus last year, and versus benchmarks. Why we look at it versus budget? Because you have plans. Everybody has plans. You put them in motion at the beginning of a year, or they can change as time goes. But the idea is that you have a plan, and are you going according to plan with your numbers, with your spending or not? Are you hitting your targets or not? That's super important to be able to compare it with your budget. And it doesn't go with like budget needs to be stuck and there's nothing that can be changed about it. But the idea is to understand, why did we steer away from budget, or how were we able to keep on track with budget? And why we look at previous years as well, it's because when you have history, it gives you a little bit of momentum, like what has happened, an understanding of the previous times, but it doesn't mean that this is how it needs to move forward. But again, understanding and analyzing what happened before will make it much easier for you to understand why your results are this way today. And benchmarks is because you're not alone in the market. It's super important as well to see where do you stand versus other brands, versus other retailers if you're acting as a retailer as well, versus other suppliers if you're acting as a supplier as well. So this is super important to know these benchmarks. Doesn't mean that all benchmarks need to be taken at face value either, but it's important to look at them. So if I just look at a very simple income statement, you'll realize that actually the income statement, the more you add details to it, the more it gives you information that serves you best. So you can even see a lot of retail metrics or commercial metrics that are readable very easily in an income statement. So I'm looking at, for example, if you segregate your sales between your sell-in, your sell-out, and your liquidation sale, just looking at that, you can understand where your efforts are going and which channels are bringing you most revenue and as weight. If we look at, for example, liquidation sales at 1%, more or less, it seems quite a healthy channel. If you start looking at this as 15, 10, 12, 15, 20%, this is something where you have to consider, why is my business being driven by liquidation sales, or by sales that are either discounted, or that I have to discontinue, or that I was supposed to sell to a wholesaler at a very big discount? To really understand, am I having a pricing issue? Am I having, for example, overstock that I had to liquidate? So just by reading 2 sentences or like 2 lines, you're able to derive a lot more questions from it that you will be able to investigate with your commercial team, or by looking at your commercial decisions. Another one that is super important is your gross margin. Of course, no business is exactly like the other, but there are some metrics and benchmarks to look at if you have a good gross margin or not. What I would suggest when looking at gross margin is to dissect it even further. Because you might have multiple channels, it's super important that to see which channel is bringing you the highest margin and the highest volume. So it's not only about volume business, but as well, is your margin in weight or percentage enough to cover all your other expenses that you could be incurring with a channel? So I'm thinking, for example, very high level. Here we have a 63% in this example of gross margin. It's a bit more difficult to understand if it's healthy or not healthy if you have different channels. But if you have just one channel, which is you sell to retailers and you have a 63% margin, you could assume that it's quite healthy. If you are in multiple channels, which you have direct to consumer, so you sell via your website, or you have, for example, wholesale accounts, or you're selling to other retailers or even other pure players in the market, like the Namshi of the world, for example. And if you have your own retail store as well, and you have a physical store, it's important to dissect your business in the different channels and look at how much each channel is bringing you as gross margin, and to see which channel makes more sense to you financially and which channel is more strategic as well for you to have, because even if the margin is small in percentage, but the volume are big and enough for you to cover your fixed expenses. Another very important metric. Yes, please go.
How do you define sell in and sell out? I mean, this is not, sorry, I'm used to seeing it as revenue sales. I've never seen it in these words. Can you expand on what that actually means?
Of course. So basically, it's a little bit of a the beauty industry Shalhoub jargon. Sell in is that if you're a brand that produces the product and you sell it to a wholesaler, that's your sell in. The wholesaler sells that to a retailer and the retailer sells it to a consumer. The consumer part is a sellout. So the reason why I have sell in and sell out in this example is that I consider that in your brand, you have a channel that goes directly to consumers, which would be your sell out. So it's basically how much are you able to sell to direct to consumers, and your sell in is how many are you able to sell to other channels that are still part of the supply chain and not directly to your consumer. The reason why we do that is you don't own the sales that the retailer you're selling to or the wholesaler you're selling to sells to a consumer. So you don't own these sales and you can't really recognize them as your own sales. You can recognize only the sale invoice that you do from you to that account, and that's a sell-in.
And question in terms of, and you might be covering this later, but are you guys going to give us some good benchmarks for kind of what Shalhoub's world is, good benchmarks in terms of kind of direct consumer versus direct to retail margins?
Yeah.
Or different channels?
We can talk about it. Usually, if you are creating your own company, again, in beauty and fashion, it's a little bit different. It depends on a few metrics, but more or less, when you are creating your own label and you are the brand, when you are going direct to consumer, your gross margin would be around the 80%. It could be higher, a little bit lower, but more or less it should sit around the 80%. And the reason for that is you only have one cost that you're giving away is to your supplier, which is your direct supplier that's creating the products on your behalf. When you are going into direct, if you're going to retailers or through wholesale channels, you're giving away quite a lot of your margin, right? So you start with 80%, and then maybe on the retail price, you give 50% to a retailer. You might give 30% to a wholesale account. So all of this needs to be balanced on how you're giving your metrics. Again, there's no exact formula because it depends on how big your brand is, how long have you been on the market, what is the volume that you can actually give a retailer. So all of these will be discussed with the retailers directly or with a wholesale account. But I think wholesaler, you can give between 10 to 15% on the retail price.
This is important because it helps with pricing strategy, right? If you want to have healthy margins. Okay, so I want to target an 80% gross margin on my direct to consumer sales, and that's kind of how you work on your COGS to your sales price, if it's, still competitive or has enough value to convert.
100%. And that brings me to what are the kind of things that would impact your gross margin? So pricing strategy, you mentioned it, is extremely important. If your margin is below, like let's say you should aim for 80% and you find yourself at the 50, that's quite a big difference. So it's super important, and it's kind of like the first flag that you should think to yourself, why? It could be strategic. You're trying to be like reducing your prices, and that's your own decision to take. Or you see that you are priced correctly versus your competitors. So why aren't you able to get the 70 or the 80% gross margin? You need to understand if there's something in your supply chain. Maybe your suppliers require high MOQs for you to benefit from economies of scale, and you haven't hit them yet. So this is where you start taking on a strategic supply chain decision. Is like, okay, instead of me placing orders once every 2 weeks, what if I place an order once every 3 months? Would that make me hit my MOQs? Would that make me hit like better preferential rates with my suppliers? These are the kind of decisions that you will be able to take from a supply chain management perspective. Another example is exchange rate. And that's why, for example, sometimes your margin goes up and down, because if you have priced, most of the time it's a little bit of a fixed price. You go with the market and you say, I'm pricing this at 250 dirhams. But if you're buying in euros, for example, your raw materials come in euro and euro goes up, your raw materials can go up, and you don't have time usually to assess and reprice. So you'll see your margin going down. On the contrary, today, the euro is going down. If you were to buy in euros and you've bought before, or you have pegged, now we're going a little bit into financial kind of things, but if you have a purchase in advance and now the euro is going down, you could have a preferential margin just by exchange rate pegging or decision that you were able to take. So a lot of things go together and a lot of things impact your margin. Let's say, for example, you had to do a rush delivery and you had to fly things with air. Automatically, that's much more expensive than with sea freight, because you couldn't wait and you had to do something quite quickly. That's why I'm saying every decision that you take on your business is reflected in your financial statement. So reading it and going in details and understanding what happened will make it much easier for you to have better conversations on supply chain, on commercial terms, and on other aspects of your business. So in the example that you give is extremely valid. So reading your margin and splitting it by channel is even much better than just reading it as a consolidated gross margin. Okay. In terms of,
I just had a question. Can we let Zina in again? I think she dropped off and she's waiting.
oh, okay, sorry.
Whoever's in charge.
She's in. All right. In terms of it's an accounting metric, but it's an important one, and it has a lot of, as well, it has a lot of meaning, which is the stock provision. It's not a cash thing, but what happens with the stock provision, and I don't know if you guys practice it in your own financial statements today, but it is an important metric, and it's the devaluation of the stock that you have sitting in your warehouse. What does it mean? So today, your stock is brand new. And we all know that with beauty products, you kind of have an expiration date at some point. It has a shelf life. And if today you purchase it, the value for you to sell it is at 100%. 6 months down the line, in a beauty product, you might have less chances to sell it at the same value. And this is exactly what it means to take a stock provision on the value of your inventory, is to depreciate consciously the value at which you will be able to sell your stock. And this is usually directly correlated with few metrics. It's directly correlated with the aging inventory. So if you see that your stock has been quite old or has been more than 6 months or 9 months or 12 months, this is when you need to start to understand what happened in my supply chain that made me have a lot of stock that is now 1 year old. Especially when your supply chain is quite continuous, or you're able to purchase or place orders every month or 2 months or 3 months. Why do you have stock that is quite significant, that is sitting above 1 year old? And these are the kind of metrics that stock provision will be able to make you think of. Why am my stock provision so high? As a benchmark, what we do is in beauty, I believe after and this is this is a decision that you can take knowing your business and your brand and the product that you sell. But for example, sometimes we say after 6 months, you start losing 5% of your value of that stock. Every month, so starting this month 7, you lose 5% continuously of the value of your stock. You could say that my product's shelf life is actually unlimited. A little bit unrealistic, because if you haven't sold them in the first 6 months or the first year, you need to think, do I need to replenish of it? Am I going to be able to sell it again at the same value? This is the kind of things that you need to consider. There are some benchmark and metrics, but I would suggest that you do a little bit of your own, depending on what the products are. But you can follow the same as Chalhoub, which is after 6 months, you start losing 5% of the value of your stock. Another important metric is shrinkage, which if you lose stock. So that's something very important, especially for you if you have warehouses, or at some point, hopefully you start having warehouses, is to account of, am I losing stock? Am I damaging stock? Is there something in my process that's making us lose a certain amount of stock? And this is what gets reflected here. And of course, part of business, we believe that you will sometimes lose stock. Some stock will be damaged. But if you see this going to like 5% of your business, it's alarming, and you need to start investigating why. And usually this happens with cycle count. So every month or after 3 months or at the end of every year, you need to count your stock versus what's in your system and match them. If your physical count is different than your stock count, this is what impacts your shrinkage here. Okay, so this is a little bit just the most painful part of finance. The rest is quite straightforward, I would say. One of the things that we do is we try to separate between your fixed charges and between the direct expenses that are linked to your distribution points. So distribution cost could be for you to be able to get your stock to your wholesalers or your retailers, any cost of shipment related to that, whether it's on you, of course, if it's on you. If you have a commercial term where your supplier, your customer will pay for that, you will have this much lower. Fulfillment costs, we separated because if you have a direct to consumer, it's really the cost to do the last mile delivery to your consumers that are buying online or through your Instagram pages. Credit card expenses, of course, this is more linked to direct to consumer as well, which usually as a benchmark, it could be 1.5% of the sales that are happening on your website, or on sometimes 2.5%, depending on the payment gateways that you have. And this is what we call contribution margin. Contribution margin shows you how much margin you have to cover all your fixed charges. And this is a little bit what you're controlling in terms of, can I take action on anything that is directly linked to my consumer? Am I overpaying shipping charges, for example? Because if you have 58% in general, it's enough. But in value, it could be not enough for you to pay all your fixed expenses. So that's why we look at these metrics as a percentage of total sale. So we put some dummy expenses here, like your rent, your staff expenses, if you pay any commissions, and staff expenses could be your back office team, or if you have retail stores, they could be in the stores selling your products. We look at commission as well, if anybody is incentivized on commission. Digital marketing could be put in your contribution profit as well, if you feel there's a direct correlation with selling the product to consumers online. Traditional marketing, or anything that you guys can do in terms of branding, events, PR, etc., can go there. Other operating expenses, anything to run your business. Professional fees, if you guys are looking for lawyers that are supporting you with some documentation, if you are actually outsourcing your financial and accounting bookkeeping, that could go there. Anything that is professional, not included in-house, could be lying here. Financial expenses is that if, for example, you're paying on your credit card and on the company credit card, and you are actually late to pay some of that, it could be exchange rates that go into financial expenses. And eventually depreciation, if you have any physical location or amortization of that needs to be depreciated over time. So that's a little bit in a nutshell. I realized that it took quite a long time to explain the income statement, but it is a very important thing. one metric that struck to me in this exercise is 17% of staff expenses. Usually that's something that you guys need to look at and say 17% in face value, it's only 70,000 dirhams in this exercise. But 17% is a big chunk of your business and your margin going to pay your staff. So this is where you start looking at metrics as employee productivity. If it's a frontliner, is my structure too big for the level of business that I'm doing? Am I in growth mode? And that's why it makes sense, because actually in a year time, I won't be hiring much more headcount, but my sales will grow exponentially. So these are the kind of things that you would look at when you see such number. The rent seems quite fair at 5%. Sometimes you will have cases where you are sitting in location and you'll see your rent sitting at 25 to 30% of your sales. And this is something where you need to as well consider. And this location is taking 30% of my margin. Is it worth it for me to be here? Is it a strategic decision for me to be here? Can I go and renegotiate my rent contract with my mall or landlord? Or because 30% of 58% contribution margin is quite a lot going to one location, for example. It could be your rent of offices, which usually should not be quite a lot. So 5% seems fair in this case. So before I move forward, do you guys have any direct questions on the income statement and the relationship between every line on the income statement? Okay.
I have a question. Is there kind of like best practices on what percentage you should be on all of these?
So again, benchmarks at face value are a bit irrelevant. So I can come and tell you, you should be, for example, at 12% on staff expenses. And you're going to go and try to understand, and why am I not hitting the 12%? But nothing is really at face value. So for example, in the UAE and in KSA, our staff expenses are completely different. And one of the questions that I got asked once is, how come your staff expenses in Saudi, and I'm giving random numbers, is 25% or 12%, and your staff expenses in the UAE is actually 20%. And it was a shocking thing for them, but it makes sense because in the UAE, from a labor perspective, it costed us more. We would have the same size of the store. We would have the same number of employees. It's just the salaries were higher at that point in time in the UAE than in KSA. Similar for the rent. The same question came back. Why is the rent in UAE much higher than the rent in KSA? And I'm talking about 4 or 5 years ago. Because we were in major malls in the UAE that charged us quite a lot because they had minimum expenses that we had to do. And we took a conscious decision to be strategically there in these locations. But in Saudi, we were able to have more favorable rates. So I can give you strong benchmarks, but honestly, you just use them as understand why you're different than the business. And if you compare yourself to the wrong benchmark, it won't serve you properly. But I can give you some numbers as like pointers to look at, which we talked about. If you're in D2C, gross margin around 80%. If you are, for example, in distribution costs, somewhere around, and again, this is a percentage of the sell-in and not the total sales that you do, but the direct sell-in to your wholesalers, it could be around 3 to 4%. Your fulfillment cost, which is direct to consumers, should be around somewhere, I think around 4%, 3%, 4%. Of course, this impacts, are you giving free returns? Are you not? Are you doing free delivery? Are you not? Is there a minimum requirement for free delivery? So more and more today, benchmarks are a bit more difficult to get, but it's always important to see, does that make sense for your business or not? Credit card expenses, if you are part of you have good relationship with the bank, it could be around 1.5% of your total sales or your credit card expenses. But if you are on a payment gateway online, sometimes they take between 2.25% to 2.75% of your sales. So in terms of rent, 5 to 6% could be good. Sometimes you can go to 8, 9, 10%. But honestly, as long as you're not in the 15, 18%, 20%, you're good. So just look for the metrics of shock or flag. It's really more about that than just making sure you're matching the benchmark. In terms of
Okay. No, that's really helpful just to better understand. So thank you for sharing that.
all right.
If you wouldn't mind just continuing that, because obviously interesting is the two marketing percentages. Obviously it differs across industry, beauty, fashion, etc., and launch stage and all of that. But what would you say is Shaloub's experience of a best practice with where you should be sitting as a percentage?
So that's quite a difficult question. And the reason why I say difficult, it's because sometimes your marketing spend as a retailer is decided by the brand. So in your contract, you have to spend X percentage on marketing.
Yeah.
Sometimes you can renegotiate this over time, which, for example, some brands will say you have to spend 5% of your sales on marketing. And there's no real definition of what marketing means. And of course, this was a little bit when e-commerce was not so popular a few years ago. Some brands will tell you, we want you to spend a percentage of purchases as well. So if you buy from us $20,000 in a season, I want you to spend 10% of that on your marketing. So it's a little bit more difficult to really quantify the percentage because it depends on your agreements, which is with each brand. And it depends on the volume and at which stage you are in your brand. So if you are in growth phase, where you really now it's time to pump money in awareness, it's time to really be able to create pop-ups, it's time to be out there, you will see your traditional marketing and your digital marketing taking a big chunk of your sales. And that's okay, as long as down the line, you're able to go back to a steady percentage. So I feel like somewhere around 5 to 8% on marketing is something a little bit more steady. But in growth phase, you could be in the 20, you could be in the 25%. Again, it needs to be justifiable. So when you're spending all of this, and we look at business metrics such as customer acquisition cost online, such as long-term value online, at the ratio between marketing and sales, we look at these metrics and we look at benchmarks, and depending on the phase where you should sit. But again, depends on your phase, depends on if you have a lot of stores. For example, we see some brands that are in multiple point of sales and they have to animate 40 point of sales. But every point of sale brings you just a little bit of cash. Together, they probably make quite good amount of revenue, but you still need to animate all of them. The marketing could be at a higher percentage. It could be in the 10, 15%. Again, all of these metrics, it depends on where you stand today. Where is your strategy? At the end of the day, your budgeting and your actual need to follow a strategy that you're trying to take. If your strategy in growth and awareness and pushing, you could see much higher percentages. If now your strategy is to lock things, really make sure that things are steady, things are clean, it's about cleaning the portfolio, then you should have much healthier percentages that you're aiming at. And you should see your operating profit percentage at a higher stage. Some brands, honestly, they hit 30, 40%. Some brands, they are 5%. But sometimes 5% of 10 million is much more than 40% of $1 million. So you need to see where you want to spend the money behind, right? And what is your growth potential? So there's nothing wrong with being a $1 million, $2 million, $3 million, even $500,000 business, as long as you have a healthy business behind it or healthy spending behind it. But if you are at the 40, 60 million and you are now at $1 million and you want to hit the 40 million, logically, you need to spend in your growth mechanisms, which are usually marketing. It could be your team. It could be opening locations. So it could go into CapEx. So you need to see based on your strategy where you want to spend that money.
Got it. That was helpful. Thank you.
All right. So we're going to move to the other two statements. So we have the balance sheet and the cash flow statement. They're very important. I see that some of you were mentioning that you keep track of not all three statements. That's okay, but it's always better and more advised to have the three of them together because they tell the full story. Looking at an income statement on its own or looking at your cash flow statement on its own doesn't really tell you much. When you put them together, that's when you can actually read much better your financials. And especially when you're going to fundraising and you really want to scale, you need to understand the healthiness of your business. And the balance sheet is what shows the healthiness of your company. Are your assets higher than your liability? Is your cash driven from debt or from equity, or is it driven from your operations? This is a little bit what we can read in a balance sheet. So rule of thumb, assets minus liability and equity needs to be equal 0. They need to have the same number. It means you have a balanced balance sheet. If you see one is not tying with the other, then there's something wrong probably in the calculation because it should always tally. And of course, the smaller you are, I feel the better you can put the right foundations to calculate and to have the right mechanism to have a healthy balance sheet. The moment you grow very quickly and you haven't put the processes in place, you will sometimes feel that you're not able to calculate the right cash. You are having, for example, wrong liabilities, etc. So I would suggest that if you don't, from today, look at your balance sheet or make sure that you're calculating right, that you actually start doing that, because it's super important metric for later on when you're ready to fundraise, if you haven't done so already. So of course, one of the main metrics of any healthy company is cash, but it's not only cash, it's actually short-term assets or current assets. So the way you should look at this, do I have enough assets or have I invested in assets? And assets means something that will give you value either today or in the short term, such as cash that can be turned into buying PP&E or property, plant and machinery. It could be turned into buying stock for your growth. It can be invested in marketing. It can be invested in anything that can push your company to growth phase. Your inventory, as long as your inventory, your net inventory is healthy, which means you don't have a lot of stock provision, means you have a healthy stock on hand, which goes back to the conversation that we've had before on stock aging and stock provisioning. So the newer your inventory, the better, of course, because you have higher chances of being able to liquidate it in an acceptable time frame. Accounts receivable are an asset, but if accounts receivables become non-receivable, it becomes a liability. So if you see that your accounts receivable, and this is a metric that we'll see later on in the KPIs, they're sitting in your receivables for a long time and you're not able to collect them, that means you have the wrong suppliers, or you don't have favorable rates with these suppliers, or you've given up probably too much leniency that is hindering your business, or your suppliers could go bankrupt. So these are alarming things to really look at. How early, or like what's the time frame of my receivables? If it's 30 days, 60 days, you're still good. When it becomes 90, 180 a year, that's something that needs to ring a bell for you, that you're not collecting your receivables on time. You probably either you're not pushing, or you don't have the right commercial terms, or your suppliers are going through a tough time and they don't have the cash to pay you. And that's when you need to start taking action with them on that. At the end of the day, the relationship with your suppliers or your customers, sorry, I meant customers, is a partnership. So anything that happens on your customer side can impact you. So you knowing their safety, you understanding that you're not pushing a lot of stock on them will be better for you. Because if you push too much stock on them and then they don't sell it, and you've projected that they're gonna buy again from you, then this is where you go into a spiral mode where you end up with a lot of stock. They're not paying you on time because they have a lot of stock that's not being sold, and then nobody wins. So a relationship with your customers and even your suppliers is extremely important to understand the healthiness of your business. And that's a little bit how we read this in terms of accounts receivable. Prepaid expenses are very normal sometimes in businesses where you need to prepay, for example, your rent, but you only see the impact on your income statement on monthly basis. But for example, you paid for a whole quarter. That's where the prepaid expenses come. Sometimes insurance is prepaid as well. These are the kind of things that will hit here, which means you've paid them, but they haven't hit your income statement because you haven't got the service or the goods yet. In terms of PP&E, which is if you are investing or buying assets that are going to serve you for a long period. It could be if you are building a store, it could be if you're buying special machinery to produce, it could be really like if you buy a location or a piece of land that you could use later on, anything that you're investing for long-term can go there. And of course, it'll be impacted by depreciation. Metrics of depreciation are a little bit different. If it's digital or computer tools, it could be over 3 years. If it's a store, it's over 5 years that we depreciated. If it's land, I think it's around 10 or 20 years. And that sits on your assets. So between short-term and long-term assets. Usually these assets are a little bit less liquid. That's why we call them long-term assets or not current assets, because you can't turn them into cash quickly if you need to. That's one explanation. From the liability and equity side, of course, if you see, for example, your cash is $1 million, you have $1 million, and then I look at your long-term debt is actually $1 million, I start wondering, your cash is not coming from operation, but it's coming because you raised debt, or you raised, in this case, you actually went and took a loan, whether it's from a bank or from friends and family or whatever that is, means the healthiness of your assets today driven by cash is actually driven by a liability. So it's important to look at them together. Another thing is accounts payable. Accounts payable is super important when you have favorable rates with your suppliers. So if your suppliers are actually your partners and they're supporting you on this journey, they will give you favorable rates, which means they will give you products, but you can pay them in 90 days or 60 days or 30 days. This is where your accounts payable will come, because you've received the goods, you started selling them, but you actually haven't paid your supplier yet. It's something that we encourage. But if this starts falling above and beyond your commercial term, means you're not paying your suppliers on time, means there's a risk on your cash, but as well, there's a risk on your partnership. So these as well are important mechanism to look at. Why aren't we paying suppliers on time? Is it because we don't have good relationship with them and they're like squeezing us in our terms? Or is it because we have cash issues and we haven't managed this properly? Or is it because we just forgot and we're trying to not have a healthy relationship with them? So that's a little bit the kind of thought process that you guys should have when looking at your liabilities. And of course, equity, dividends, and retained earnings are, if you raise equity and then whether you fundraise, they sit on your cap table, the equity will be reflected here. If you decide to pay dividends at the end of a fiscal year because you were successful and you were able to generate a lot of operating profit and like cash, you've taken a conscious decision to pay dividends to all your shareholders, this will be here and will reduce the retained earnings that you keep. The way we think of retained earnings is what is the level of earnings that you want to keep in your company for growth and investment purposes. So it's important that we don't pay everything in equity, in dividends, but we keep enough for us to sustain us for the coming cycle, whether it's 3 months, a year, 2 years, whatever that cycle is, to push for growth and to push for sustainability of our business. So that's a little bit on the balance sheet. Do we have any questions so far? Okay.
I actually have a question. Can we go back to the income statement? I was just wondering, I know that you mentioned that benchmark are very much adaptable to each country, but in terms of gross profit, is there a specific number that that the business should be within? Like 70%, I saw on the...
Here, it's more on 62. Is that what you mean? The gross profit, you mean on this line, right?
Okay. So that doesn't include the cost of goods sold, or it does include it?
Because the gross profit is after gross margin.
Okay, and it includes all the discounts that have been done on the inventory over the period of time.
Yes.
Right.
And So why we use benchmarks, but as well why we should use why we should look at the margin versus the previous months and the previous months and the same months last year. This is why it tells us, did we take any decision that hindered our business? Was it the right decision or not? And you've mentioned something that makes sense is sales period. Everybody goes on discount and that's normal. But if you realized that 4 months of your year, you had margins at, let's say 70%. And then when you went on sale, your margin dropped to 30.
Yeah.
That's fine. But if the volume of your sale period in the months of May has been so high that the sum of the 5 months has driven your margin quite low and not equitably low, that means your sale period is overtaking your full price period. And that's something that will make you think, am I targeting the right customers, or are my customers very price sensitive and I'm pricing wrongly?
Okay.
These are the kind of things that will come to your mind. But again, I don't want to give you guys a certain margin because I really don't want to be misleading you in any way, but always look at your margin of where you were before and where you stand today and versus your benchmark. Is it something feasible or not? So when you have done your business for a year and your margin has been at 60% and you budget for the year after to go to 70, it's important to understand what are the blocks that are going to get you to 70. Are you opening a direct to consumer channel and you're investing so heavily in it that's impacting your margin upward? Are you going and negotiating with all your customers better rate for you and actually you're taking away margin from them? That increases it upward. So build these building blocks to understand if someone is pushing you to go to 70 or you have ambition to go to 70 while you've been at 60, why? How will you get there? Are you going and negotiating with your suppliers better rates? And this is giving you X percentage points of help. So it's super important that when you're talking to anybody in the business, that if they're giving you a benchmark versus what you've been trending at, that before accepting it, understand if this is something you can actually aspire to get to or not, if it's feasible or not, and if it's strategic for you or not as well. Sometimes you would decide that you want to sell below market value because that's how you want to go and enter the market. Again, no comments on if this is the right strategy or not. That's not my place, but it's really more of your strategy is translated into your numbers. Okay.
Thank you.
You're welcome.
I have a question also for the previous sheet.
Yeah.
Because like now entering like more retail and you have like the bigger departmental retail stores and the smaller ones. And now with the negotiations, I'm figuring out like how, what can you do, or like, because you want to have like a good partnership, sustainable partnership and a good deal, of course, but like, what would you say would be like a healthy range to
Okay. So I just want to confirm one thing with Sinead. Have they done the commercial and supply chain with Ellie or not yet? Okay, just because this is a topic that's going to be open soon with another, I'm going to call them, I don't know, mentors?
Internal expert.
Mentors, internal experts. It's a big subject. And honestly, because I'm not from the commercial background, I understand the commercial, like the commercial behind it, but it's important that that question would be answered by someone from the commercial team.
Okay.
And you will have a session with that person and it'll be much more, how do you say, fruitful for you, honestly.
Perfect. Yeah, thank you so much. Thank you.
You're welcome. Okay, so finally we get to the cash flow, and honestly, in the next 5 minutes, and then you won't hear me talk, you'll hear Marco talk. We get to the KPIs. So in terms of cash flow statement, very important statement again, and it's only focused on your cash and your cash balance and your cash healthiness. So we split it into 3 major categories for your spending habits or your cash inflow habit. And the cash flow from operating expenses, the cash flow from investing activities, and the cash flow from financing activities. I would focus personally quite a lot on the operating part, because if your cash flow from operating activities is negative, sometimes it can be. The reason is to understand, again, why. Is it something that you cannot turn around, that means your operations in themselves are not sustainable. If it's because you've put a strategy for growth mindset and you really are investing this year, but next year your operations are going to be healthier, they're going to like push for more sales or revenues, hence this will flip, then you're in a good position. But it's super important to see, are your operations sustainable? And that's the question that I ask myself when I look at your cash flow from operating expenses. So you're receiving revenue from your customers and you're paying to acquire inventory. Some years or some months, you will have to pay a lot of inventory that will only be sold in the next 2 to 3 months. That's important to know as well when you're looking at this. Will this, now where you're paying this, will it increase the cash that you will receive from customers or not? And that's an important metric to see. The cash paid to employee, if your resources or your HR resources are a big part of your business, you need to separate it and really see how much are you spending on employees or headcount. And eventually any other cash that you pay by other operating expenses. Now, if a year your marketing is a driver, then I would suggest you separate it as well and you have a focus and you shed the light on marketing as well separately to see how much are they taking up from your cash. The cash flow from investing activities is important because usually if you don't go for financing, what you make in operating expenses or operating activities as cash flow, you reinvest in investing activities. And the reason is you invest with something that will bring you growth. And that could be opening a store, for example. If you don't have enough cash to open the store that will drive growth, you won't be able to invest in that channel. So you will have to go, for example, for debt or to raise funds to be able to do that if your ambition is to invest in PP&E. Another example is like you have to buy a new machinery because you need to find efficiencies in your supply chain, for example. If you're not making enough in operating expenses to spend here, you will have to go for debt or equity to be able to inject this into your investing activities, which are very long-term usually, or many sometimes. It doesn't mean that all companies need to have investing activities, but in general, if you really want to diversify the way you are bringing your revenue and you want to open up new channels or you want to invest in a supply chain or whatever that is, then you need to have investing activity spending. And eventually from financing activities, if you've raised debt or equity or repaid any of this debt or equity, this will have inflow and outflow on your cash balance. So I think that concludes a little bit our 3 statements. Do you have any questions before we move to the next section, which is focusing on business, online and offline KPIs? All right. So I can take a break and Marco.
Hi, everyone. So I think after this, quite detailed part or lesson with Joanne, I'm going to talk about some other metrics and KPIs that we look at when analyzing a business, let's say. So something we definitely look at your 3 financial statements, but at the same time, we'll be using some of those lines and some of those numbers to calculate other KPIs or other ratios to kind of see how you're performing, where you're at right now, and compare them to other businesses in a similar, let's say, state. So we're just going to go over some business KPIs, offline metrics and online metrics. Some of them are quite different and other of them are quite similar, just in different scenarios. So just looking at basic business metrics, KPIs, you can look at your CAGR, which is your compounded annual growth rate. It's just a metric to see how your company or business can be growing on a year-to-year basis, or you can even do it on a month-to-month basis. We look at things like inventory coverage, how healthy your current holding of inventory is compared to your COGS, and if you need to increase or decrease that to see how much inventory you currently hold. Your days receivables. This is also a metric to kind of analyze how well or how you're cashing in your receivable payments. it gives you kind of an understanding of if you need to change, let's say your terms with whether it's a lender or customer or whoever it is. We'll look at VPT, UPT. That's technically looking at your actual pricing and your total revenue compared to the amount of products you're selling, depending on the channels. And two very important metrics that we're looking at when looking for financing is your runway and your burn rate. It's basically they're talking about the amount of cash you need how much cash you need for a certain amount of period, and how long would a certain amount of cash keep you alive, basically, for your next fundraise or for your next capital injection. I'm not going to go over the details of the equations and the calculations. I think they're all on the screen. You can feel free to ask any questions you have about them. On the right-hand side, we kind of try to give you some metrics that you'll be looking for healthier ratios. Honestly, I think the same goes in terms of your financial statements. It really depends on your company and where you're at right now. In terms of, I mean, for me, from my experience when I'm analyzing startups and companies, I look at them at multiple various stages of their lifetime, whether they're at a seed stage, at a Series A or B or C or D, or even pre-IPO and public companies, and it really depends on where they are. So sometimes you're going to be burning a lot of cash, and that can be a positive thing that can promote high growth and fast scaling, which is quite attractive to an investor. And sometimes if we don't believe in that growth, it can kind of scare us and say, oh, you're probably going to need to fundraise again soon, and that's going to dilute our stake. So it kind of gives us a hint of your cash healthiness.
So I just have a small comment on the inventory coverage. Usually we give benchmarks on a backward-looking COGS. So the average COGS that you've spent or that you've had for the past 12 months, for the past 3 months or 6 months, whatever metric you want to use. The thing is, sometimes we look at it and we're like, oh, amazing, 3 months, that's very healthy. Then when we look at your forward-looking coverage, you will have 0.5 months. It's because you're in growth phase. And actually you don't have enough stock versus the strategy that you're putting to really grow and pump the business. So it's super important to look at these two metrics in backward looking and forward looking. So if you have an ambition to grow exponentially your business for the next few months, and you're basing it on the previous months, your buying will be too little and your inventory will not be enough to sustain that growth. And then you will see that you're lacking behind in terms of revenue versus your ambition. But that's because you never had enough stock to begin with, or you didn't place the orders in time, or whatever that thing is. So again, these metrics are usually for established businesses that have been running for quite some time. They have a regular supply chain management kind of thing. While if you are looking for growth, you should look at making sure that your inventory is enough to sustain your coming months of selling. That's a little bit on the inventory coverage that I would add. In terms of value per transaction and UPT, super important to calculate them, because the UPT will increase, of course, the value per transaction, but at the same time, this is when you can think of cross-selling. If your business is driven by one product, will it benefit from being in a multi-brand category, for example, like on a platform that shows multiple categories, multiple brands? This is something that you have to think of, because when you're selling online and people will have a UPT usually of one, how will you push them to have UPTs of both? Sometimes you can do bundles. You can, like, if you buy 2 to 3, you get a specific discount kind of things. But if you if you don't want to go into that route and having a UPT of one, but you want people to increase their basket, so you have less cost directly to you, one thing that you could do is get associated with a multi-brand or multi-category kind of platform. Again, these are things that you could consider, but it will depend on the commercial terms that you have. So Another thing that we try to do is we will compare now, Marco will take you between the VPT and the customer acquisition cost online as well. So, or the VPT with how much expenses you're actually getting. And one thing to do is that the lower the value per transaction, sometimes it'll be okay because you have a lot of traffic and a lot of visitors, whether it's offline or online. So you will focus on the volume much more. But sometimes if you are more on targeted, less volume, the value per transaction should be enough for you to be able to sustain all the direct expenses and indirect expenses with your business. So we link value per transaction with unit economics, which is every unit that you sell, is it enough to cover all the expenses that are directly linked to taking that unit from your warehouse, creating it, all the things, all the way to your customer. So that's a little bit how you need to think of value per transaction. Of course, if you're in a B2B metric, these metrics are a little bit different, but this is more for B2C or direct to consumer. All right. Offline metrics.
Yeah, so we're going to also compare some metrics that we look at when we're looking at a business that's mainly, let's say, on a retail business that has an actual physical brick and mortar store. There are different analytics that we'll compare, which, I mean, some of them can be like your store traffic, how many visitors are coming in a day, if you need to increase or decrease that. I mean, you probably wouldn't want to decrease it, but your conversion rate, looking at basically from this traffic, how many people are actually having a transaction, how many people are buying something, your employee productivity. You want to look at, like, if you have a store, how many salespeople you have in the store, and whether you need to increase or decrease the amount of salespeople, which will affect your expenses, and how productive they can be in terms of the transactions each. I mean, you're having per amount of sales employee. And you can look at productivity per square meter. It's more looking into your store and your rent, and looking if you actually need to pay this much or need this size of a store to sell your products, or maybe you can actually decrease your store size and be able to sell the same amount of products with the same amount of employees in the store.
Yeah. So on this, I'll give you some tangible examples that we've had previously when I was in finance. Store traffic is very difficult to compare across regions, across malls. So sometimes we fall into store traffic and conversion rates comparison between different locations, but it doesn't really make a lot of sense. So I'll give you an example. In Kuwait, some of our stores had 40% conversion rates. In the UAE, some of our stores have 3% conversion rate. We shouldn't fall into, in Kuwait, our conversion rate is better, so we should invest much more in Kuwait than in the UAE, just because the metrics are not at all the same. So when you're trying to decide on a location, where you should open, next to what store you should sit, of course, there's a lot of strategic decision that you need to take, but as well, you need to know the traffic that is facing your stores next door. So you need to try to get that information. Some of the times what I would suggest, if you're opening a new store, just go and spend 3 days in a row, some on the weekends, some during the weekday, and try to see what is the traffic, because sometimes people will not give you this information. So if you have competitors next to you, they will never come and tell you this is how much traffic we get. But it's important for business planning that you just go spend, you count, honestly, manually, growth hack it in that way, and you count how many people are going in, what is the traffic like, is it the right customer for me, for my brand, is it the right level of traffic? And again, one point that Marco mentioned that is super important is understanding the size of your store versus how much is your ambition to sell. Sometimes we fall into, I want a big store, I want a shiny store, I want a flagship store, but then it will end up costing you much more than how much you can actually make in that store. So these are the kind of things that you should go and compare with others, what are their productivity per square meters, and comparison to similar brands that are in your area is how you should go about it. So yeah, that's a little bit of like previous kind of things that we used to have. I know that we used to have, for example, a productivity per square meter as well on buying and and visible stock. So that's important from a beauty perspective. Sometimes when you take a location that's you're locked in, you built a location that deems a little bit big. One of the things that we used to do is we had to buy a lot of stock to show a full store, right? We had enough SKUs, we had enough representation, etc., etc. So it used to cost us not only a lot on rent, but we used to have a lot of stock left over because we had to buy much more than we could sell. So one of the things that we actually did is we made the store look smaller, just visually. Yes, it didn't serve us on rent, but it actually served us on reducing the stock investment that we had to do. Sometimes, unfortunately, you would be locked into long-term costs that are not favorable to your business, but it's important to start thinking a little bit more, okay, practically, how can I do this? What's the impact of me having that big store on my business, not only from a rent perspective, but from all different as well. For example, you have to hire more staff sometimes. So if your store is a bit too big, you have to have more staff because they have to cover all the areas, but you're not selling enough. So when you go offline, which I don't know if you have that plan, but it's important to look at all the things and to understand what is the right volume or the level of the store size for you and for your business. Of course, taking into consideration your aspirations of growth. All right?
Yeah. And then we're just going to go over some similar metrics that we can see on online stores or websites or marketplaces, something that we compare rather than traditional brick and mortar. Similar to foot traffic, you'll be looking at web traffic, the amount of visitors you're getting on your website in a period of time. The similar metric you can go for conversion rate, where you're looking at the amount of visitors that are actually going for a transaction on the website. You're looking at your return on ad spends, basic or revenue generated from ad spends. Basically looking at trying to figure out if your ad campaigns are actually profitable, if you're generating a good amount of revenue based on every campaign you're having, and whether you want to continue through that campaign or not. Another metric that we look at is your customer acquisition cost. So in layman's terms, basically how much money it costs you to acquire a new customer. It really depends on what stage the business and the brand is at. But what you're looking for is that it's basically going to be comparing it to your LTV, which is our next metric. It's your the customer's lifetime value. And it's basically how much revenue you can generate from one single customer. So mainly what you're trying to find is a good ratio between your CAC, the cost of one customer, and the amount of revenue that you'll generate from that customer. You're looking at, you ideally try to look for a 3-to-1 ratio. So it costs you a third to acquire a customer, depending on how much they're going to be paying you back in terms of product purchases. And these are kind of basic metrics we look at or analyze when looking at an e-commerce website or like a marketplace, and use them to compare with other, let's say, companies. So looking at all these metrics that we just went through, these kind of give you a snapshot of where you are, and using them to compare with other businesses that you aspire to be competing with, you can kind of use them to create your business plan, your pro forma statements, or your future outlook. I don't think we've asked the question, but have any of you already have like a 3 to 5 year long-term business plan or pro forma statement? Have you already calculated that or like mapped it out? Sounds good. Very good.
No, I know probably that two of you have already that fully planned, and some are in the works.
Okay.
From the survey, right?
Yeah.
So using these ratios, basically it can kind of help you predict and project where you want to be. It can kind of help you. It gives you information on where you want to spend, where you need to minimize spending, and to achieve your future goals. Same goes to the financial statements when it gives you a snapshot of where you are. These ratios are just additional to that. So with the financial statements, with your income statements, basically with your business plan, you're going to be prolonging it and trying to, let's say, better or improve on some metrics and some ratios. In that case, whether it's your gross margin, profit margin, or you wanna decrease your rent to revenue ratio, your staff expenses. All these metrics kind of help you adjust future costs and see where you need to increase or decrease some spending. And that kind of, let's say, gives you a better outlook into the future.
Yeah, so maybe yeah, go ahead.
Are these quite Middle East centric? For example, like the ROAS, because like the US is more expensive, or is this kind of more a global benchmark?
I think when benchmarking, we can't, I mean, again, I don't think we can give you a really precise term, because it really depends on the state of your company, or at which point you are at right now. Like, just a quick example, like right now I'm doing due diligence on a company that have a very, very high ROAS and CAC, let's say. But we can tell that they are generating a good amount of new customers that are able to cover up on these costs. And these customers, if they have a lifetime value and they're repeat customers, then we see it as a very good sign, because we're able to keep these sticky customers for a longer period of time that will generate value over a longer period. But another company that, let's say, we passed on in the last couple of months, turned out they were based in the US, and they recently hired a new marketing manager, and they were going, let's say, they're on a marketing frenzy, and they're spending a lot on their advertising. And from what we saw, that it hadn't had such a big impact in terms of new customers. So it's more of a red flag over there, and kind of tells us to back out, and tells the company that you're kind of spending in the wrong direction. So if you have high costs that are being able to generate a return, then you're in a green zone, so you're fine with that.
And as well, just to continue on what you were saying, ROAS is not a metric that is every month needs to be 5, or you should aim to that. Of course, it's impacted by seasonality, and it's impacted by the region that you're in. So we know, for example, in the UAE, the 23rd of November is high Black Friday. Everybody goes on discount, and like heavy discount. In that period of time, you need to decide, okay, I'm gonna go head and head with the big players in the region, which are usually Noon, Namshi, Sephora, etc., etc. Do I have the capital to go and still acquire these customers from them, instead of them going to buy a similar brand or similar product from somebody else, then coming to me? And this is a little bit what you need to say. Should I turn off my ads at that point in time because I'm going to waste my money? For example, they're all going to put millions of dollars behind this 3-day weekend. Even if you put $10,000, maybe you'll be able to run some ads, but the competition is so fierce that your cost of acquisition of customer will be so high. And we've seen this with a lot of our brands throughout the year. For example, in regular full price months, they would have, for example, a CAC of $50. They get a lot of new customers. They have a healthy CAC because their average transaction value is $250. They pay $50 to acquire that customer. Perfect. During the sale period, they went sometimes hand in hand. Their average transaction value fell to $150 or $120, and their CAC increased to $150. That's probably not good. And it could be okay if they were able to acquire and retain a lot of these customers. But if we feel after these periods where we tried it, that customer only came because of the discount period and never came back, they're probably customers that you don't want to attract throughout your year. So you change your targeting and you fix that next time. So these are the kind of things on how we think of ROAS. because it really translates from your marketing strategy online with how your customers, are you well targeting your customers? Are you competing with the right people as well? Sometimes maybe you're competing with the wrong audience or the wrong suppliers or competitors. So this is something to consider as well. Where do you position yourself? Do you need to go above and beyond to get these customers to you? And of course, there's something that we didn't put here, but as well, churn rate. How many customers are you losing from a month to another or from a period to another that are never coming back to your website? That's important as well to see. If you are spending so much money in acquiring these stock customers, but they're coming once, your LTV is going to suffer. And that's why we look at LTV for them, and you paid $500 to acquire them. But these people, every time they come back, and they come 3 to 4 times a year, and they spend every single time $200, you're in a healthy relationship with that customer. So that's a little bit how we want to think about them. Again, we put these benchmarks. They're a little bit more advanced for like companies who are quite stable. I would say even the 0.8% conversion rate or higher than 0.8. Sometimes you see that your websites are converting at 7, 8, 10%. When you don't have enough traffic, or it's not enough traffic, when you have targeted traffic, actually, your conversion rate can be really high, which is good. You're not spending so much on clicks for people to come to your traffic and not convert. You're actually targeting the right audience. You're not working on volume, you're working on target. So your conversion rate is healthier, even better than the benchmark that we gave. But if you are in a competing market and you're going head with, just gonna give an example, the Sephora or the Faces or whoever of the world that are actually multi-category, multi-brands that can attract so many customers, yes, their conversion rate is gonna be around this 0.8%. And if you're going in that direction, if you find yourself at 0.3%, then this is alarming, and you need to understand, is my journey online the best journey? Am I attracting the right customer? And you review your funnel of customer acquisition. But again, your question is very valid. We tend to put our benchmark based on the market that we're in. Of course, some benchmarks, if we haven't tested it in the market, we can view externally, but this will all be impacted on a period, on seasonality, on the kind of customers that you're targeting. So there's a lot of variables in this case. Okay. Any other question or comment, something that you guys have seen in your own businesses? It'll be good as well to see, have you started looking at these metrics, especially online, or not yet? I don't know if one of you guys wants to comment.
Yeah, I think on our end, sorry.
We've definitely been tracking this in the US, and we've noticed, massive jumps across things like CAC over seasonality. I mean, trying to compete over Black Friday through to the holiday season, we were looking at, around the $40 mark, and that only started to correct itself closer to February. So that was US specific, but yeah, I mean, we keep a close eye on these things.
Yeah, so I can tell you, that's why I didn't give a CAC value. I really said to compare it to the average transaction margin that you do. So let's say if your value per transaction is $100 and you have an average margin of 80%, that's $80. If you're spending $40, you're still quite healthy. But of course, if you're spending $20, it's even better, right? So again, and I think this is a good learning to see, do I want to compete again in Black Friday? Did it bring me the right customers that I was able to retain or not? And this is where you can analyze and see. We see the same thing in the region here, not the same values, but that seasonality that goes up and down depending on who's spending so much in the market. Are you targeting? Sometimes, for example, you see that you're not targeting as per the general consensus, right? So you're targeting a very niche customers. And then you see, for example, a player who's betting on your name, for example, on Google. So you see yourself having to spend even more on Google ads to be able to get back up. And that's where SEO or the management of the search engine is super important. Are you giving the right titles to your product pages? Are you giving enough description that Google's algorithm is favoring you versus your competitors as well without you having to spend so much money. And that's how you start thinking about all these mechanisms together. Again, I'm not an expert on performance marketing, but I do understand the relationship amongst all these metrics that you would be looking at.
Yeah,
So-
I mean, quite honestly, sometimes during those seasonal things, it's better to, look to revenue within your own database and focus on CRM and organic content rather than ads. We would look to maybe trying new things like Singles Day, which is more up and coming instead of Black Friday. But these are all going to be A/B testing at this point.
100%, yeah. Anybody else? I think someone else had a comment as well.
Yeah, I think we've been experimenting also in the US mostly. And what's ended up happening is we just realized that our CAC was far too high for our average order that was coming in. And then that was mostly on Facebook and Instagram. And then we moved over to Amazon, and our Amazon is pretty one-to-one. But what I was interested in is one thing you shared was like having customer acquisition cost of 25, and then having, the average cart value being 250. I don't see that, like, I've never kind of heard that. So I'm intrigued kind of by that, because it's always kind of like the LTV to CAC being closer, exactly like you mentioned, to 3 to 1.
So yeah, if there's quite a big difference in your transaction value or margin compared to your CAC, then just go ahead. I mean, you can do the comparison with LTV, because sometimes when you're looking at it, we're looking at specific periods where we're not sure if the customer is going to be sticky and if he's going to last a long time with us. But on a general perspective, yes, you can definitely compare it to your LTV. And if your LTV is higher, and depending on what ratio you want to reach, then your CAC, then you are benefiting from every new additional customer.
Yeah, I mean, for me, it's additional metrics, right, of comparison. If you're doing CAC to LTV, that's practice. The reason why I would suggest, for example, to look at it on average transaction margin is because if that customer doesn't come back, did they give you at least enough margin for you to sustain yourself? That's something a little bit to think of. Again, these are suggestions, and no metric is to be looked at alone ever. And that's one of the examples that Marco was saying, is that sometimes a metric could be very, very positive, but then looking at the whole picture with all the metrics and how they work together, you see that there are some inconsistencies, or that things don't add up, or they're spending too much, for example, and that's why there's something happening here. Again, these are a little bit of like metrics and mechanisms that we look at, and that's how we see. Again, CAC, if you're in growth and you really believe that you're targeting the right customers, and customers are coming back over and over again, they come every month. It depends on, of course, your business, but if they're coming back a lot and you are benefiting a lot from their LTV without having to get them again in your funnel, that's perfect. Even if the first time they didn't spend enough. In general, we see that with customers, when the first time they have trust issues a little bit, or they're not sure about your products, or they're not sure about your payment gateway or your website, etc., their transaction value is low. And then the second time it gets higher, and the third time it gets higher. And we've even seen that in some of the startups that we have here, where the first time customer doesn't spend a lot, and then it increases by 40% their average transaction basket. So, or transaction value. So these are the kind of things that we see in general, and a lot of metrics will be adapted to your own business as well. So we encourage you to have as many metrics that make sense to just look at and analyze.
Okay, thank you for sharing that.
All right, any other comment or question on the online, offline, and business metrics? All right, now to an important subject, which is the financing methodologies and how to raise capital. And I leave it to Marco to go over them.
Before we start, have any of you already raised a round of financing, whether it's through angels or a seed round, or taking any debt on the company?
We've raised a pre-seed round.
Okay. I mean, it was just general knowledge to understand where you are, but basically, when looking on raising capital, there are two different or main ways of doing so. One is through debt financing, and the other one is through equity financing. Debt financing is basically, in short, layman terms, taking a loan against the company and borrowing money from someone else and expecting to pay it back at a later date. Where on the other hand, equity financing is basically selling a part of your company, selling shares of your company to an investor without having to pay them back, just splitting, let's say, the rewards of the company together. So there are pros and cons for each method. I mean, we can go through them one by one. Debt financing, I think one of the biggest pros is that you're retaining full ownership of the company, depending on how much ownership you currently have. It's a relatively much simpler process than equity financing. You can definitely find debt investors, you can find banks, you can find even like venture debt companies that are willing to lend you money against something in collateral of in your business. And depending on, let's say, the current market around the world, you can negotiate your terms with your lender. So a lot of, let's say, up and coming and fast growing startups will be able to negotiate much better terms than riskier startups. Some of the drawbacks, obviously, you're gonna have to repay your loan at a certain amount, a certain period of time. It's gonna have some interest as well. So when you're gonna have to pay back, I mean, it's kind of like a personal loan, just on the company rather than yourself. And when you do have a loan on the company, that's going to increase your liabilities, whether it's a future payment or it's going to also be, it's going to show on your balance sheet, and it's going to impact, let's say, the state of the company. And finally, it impacts your cash flow as you have to have those repayments. Let's say your free cash flow, your future cash flow is going to be impacted as well. You're not going to have the same amount of cash as equity financing. With equity financing, the pros is definitely less risky. The investor is taking a big risk, while the company, you're not taking any, you're not taking on any future payments, so you're not taking that liability. And another big pro of equity financing is when raising capital, if you're able to find, let's say, a strategic investor, then you can get a lot of value from the investor themselves. Even us, like Shahoo, when we're looking on investing into a company, a big thing we look at is who are the current investors, because typically they'd also be advisors or on the board where they can have a lot of insightful comments or insights to add to the company and be able to help the founders on the right path or trajectory. So, the cons of that is you're definitely going to have to sell a part of your business, so share some of the benefits of it with your investors, and you might find yourself in a situation where your investor if your investors are on your board, you might find yourself in a situation where you have a conflict of opinions in terms of where you want the business to be or where you want to head. A lot of times the investors can be very pushy and looking for, let's say, short-term growth, short-term results, rather than the branding and the future of the business. And finally, you kind of have to keep your investors satisfied. They're giving you the money. You're hoping to probably raise more capital from them, and they're just there. They're part of your stakeholders and shareholders, which is a big responsibility on a business. Yes, Rosemary, I think you have a question.
Yeah, so you mentioned that new business have more favorable terms than more existing businesses when it comes to debt financing.
So when you're looking at a business that's able to scale more rapidly and show better results, then you might be able to negotiate better terms. But at the same time, when you're looking at a larger business that is more stable and can show future cash flows, then you might also be able to, it all depends, again, it really depends on what stage you're at right now.
No, just because you mentioned that early stage company are able to negotiate better terms.
So if you're early stage and you're let's say a lot of the times when you're looking for terms and you're going for debt financing, you'd also do, I mean, some of them also do equity financing at the same time, so that you're not sharing selling a large part. So when you're raising and you're getting some cash, then you can negotiate at a earlier term, at a better term. Sorry, I don't know if I said.
No, sorry, I didn't understand. How can we get better terms? What is the situation that we have to be in?
The situation is that you have to show that you'll be able to scale while maintaining positive cash flows. So you're able to pay back the loan. Basically.
Okay. And basically when you say show, like you can project and forecast, or you actually have to show your bookkeeping records?
I mean, it's going to be based on your forecast, but when doing DP, they're going to look at your bookkeeping records as well. But so
this is why you meant when you said that new companies who technically do not have real data but have forecasted data are able to negotiate better terms, is because they can forecast, whereas someone who's been actually in the business has gone through some hurdles, and then the data doesn't really show like as pretty as forecasts.
Yes, correct.
That's what you meant?
Yes.
Okay.
And at the same time, when you're, let's say, I meant it more for like a SaaS company. Let's say that when they're scaling, it's quite exponential, and they're able to scale at such a high pace. You're able to generate cash at a much faster pace because you don't have as much expenses.
Yes.
So if you're able to generate that cash at a much shorter term because of your current stage, then it's more attractive to give out the loan where I can minimize my risk as a lender.
It's more attractive to do what, sorry?
If you can show that, like, if you can scale and generate cash at a faster pace, then for the lender, it's more attractive and it's less risky. So I'll be able to negotiate a lower term.
Okay, perfect.
On a lender side, or it'll be more attractive. Lower terms can attract lenders.
Okay, thank you.
So
I have one question.
Yeah, please.
Yes. If you look at Chalhoub Group, like what are the most important things when you are looking to invest in a new company? What are the most important things you're looking at?
So generally, when we're looking, I mean, there's a lot of factors and variables to take into account. We definitely first, before even looking at your finances, looking into your statements, we think about the idea itself. If we're how comfortable are we with the current with the business offering, and where do we think that will be in a couple of years down the line? So there's a lot of times, let's say nowadays you can see NFTs and cryptocurrencies are booming. Everyone's investing. A lot of people are investing in NFTs, and the amount of capital that's going into it is quite high. But that's something that we don't necessarily know where it will head or be in 3 to 4 years or 5 years. So that's taking on a lot of risks from our side. So we typically want to analyze the future of what a company can offer right now would look like. Another thing we look at before looking into your books as well is how able your company can pivot into adapting to different circumstances. So if you are in a line, I mean, it might not really matter in terms of, like, let's say, beauty so much, but if you're in a, let's say, tech, and your tech might be obsolete and not necessary or a necessity in a couple of years, then we look at things that, like, being able to adapt that technology to a different use case. And while looking at that, we also like to analyze the team and how strong the team is and the investors. Those are more of the nominal metrics that we look into. And then we go through a due diligence process where we look into your finances and your KPIs, see if there's any red flags, see if there's anything very attractive if you have a very low CAC, let's say, and then that kind of gives us information on how well or your branding or product is, how much people like it, and so on and so forth. So it's a combination of a lot of these elements that we take in. That's why it's quite a lengthy process. Then we kind of take the decision from our side.
Okay, thank you so much. Actually, one question more for because I read that Chalhoub invested in Le Bouche Rouge, the lipstick. Yeah. What is like because of course it's like innovative, also vegan. What was like the thing it makes Chalhoub investing in the product or the most
in
important?
general. So right before we invested in La Bouche Rouge, we were writing our thesis, and part of our thesis is that we wanted to invest in sustainable and clean beauty, which La Bouche Rouge kind of offers, let's say, which through their recyclable packages and the packaging. So it definitely fit there. We look after we like the business, like let's say the business model, and it fits into our thesis and our categories. We then enter a deeper stage in the process, and we start looking at their financials. We're looking at how they've performed since they've started, how long it took them to grow to the stage. Is there any red flags out of everything we just discussed, your ratios, your financials? If there's anything we don't like, if there's anything we like in specific that we think we can leverage to grow the company at a faster scale. And then we also looked at the team that they currently have. We looked at some of the investors. We really like a lot of the investors that are on their cap table. And from that, let's say, for an example, some of their investors are large French beauty companies that are known worldwide, and they're able to give a lot of insights. So is Chalhoub as well. So we think the combination of this plus a few interesting or exciting factors that La Bouche Rouge had, we can definitely help or see the company grow at a fast scale in the future.
Yeah. Thank you so much.
No worries. I think in terms of the two financing elements or instruments, we can move on to let's say a few terms or walls we reach when coming to fundraising or equity funding. One is the valuation and the cap table and the dilution of shares. So the valuation is basically the value of your company in dollar terms. Typically, when calculating that, we do it in two ways, depending on what the company is or the industry they're working in. One is a discounted cash flow, which is a method of calculating your future free cash flows on a today's basis, so discounting time value of money. And the second method is basically by using comparable companies, by using similar company multiples with your current metrics. So whether it's a multiple of your revenue, a multiple of your EBITDA, a multiple of your GMV, you can use benchmarks and comparisons with other companies to kind of estimate your value. Let's say you're selling $1 million of revenue, and you're trying to use multiples to get your valuation. You can compare yourself, let's say, to publicly traded companies or private companies that recently went through a transaction that valuated themselves or had the transaction at, let's say, 5 times their revenue. Then you can use multiple different comparisons and get an average and use that for yourself. So if the average was 5, then you can say, okay, you sold $1 million, your value is about $5 million, use 5x revenue. You can do the same for your EBITDA. You can do the same for your GMV. You can do the same for your PE ratio, depending, on your current state. There's a lot of variables that can be used for multiples. A lot of the time, we'll use the multiple valuation and compare it to the discounted cash flow, because discounted cash flow is more of a accounting metric or a financial metric where we can actually see the value generated or the IRR returned to the investor, whereas a multiple is very dependent on the markets. So if they're quite close to each other, then we can say that we're at a good valuation or a healthy valuation for an investor. Obviously, as a brand, you'll try to be above that valuation. Second is the cap table. The cap table, we don't really have to go too much into details. It's a list or it's a table of all the equity owners or shareholders of your company. It shows how much everyone owns of the current company, their share prices, and when they invested. So it kind of gives you a snapshot of the holding or shareholding structure of the company. As an investor, the way it matters to us is when we invest, we typically like to see that founders still have a good amount of shares in the company. We do so because when an investors, they do believe that for the company to grow and scale, the founders must still have, let's say, a lot of value add and a lot of incentive to stay with the company and grow together. A lot of times when we're looking into investing in a company that's, let's say, at Series C, we'll take a look at their cap table and we'll see that the founders have already been diluted a lot and like, let's say, hold 20% of the company. And we feel that if they go for an additional investment, then they'll lose a bit of motivation in the company and wanting to grow it. It's not, if you're owning a very small part of it, it's not your thing anymore, which can kind of, let's say, omit some future growth. Finally, we'll look at dilution. We'll talk about dilution. Dilution is basically the reduction of a current shareholder's position or equity shares. So, if we're going to look at an example, you can look at it like if you're like a piece of a pie or a pizza. One whole pizza, right? Let's say, can be cut into different multiple amounts of, let's say, slices. When you're starting and you have 100% of it, you might have one share, basically your shares, or 100 shares that are all owned by you. And as you sell a proportion of the company, you're increasing the amount of shares that the company has. And when doing so, you're basically decreasing the percentage of the amount of shares you have or any shareholder currently holds. This happens typically when you are fundraising, when you are equity fundraising and selling shares of the company. And when doing so, you're going to have to issue new shares, and your price per share is also going to decrease as the value is going to stay the same, but you're just going to have more shares of one value, and the price per share is going to decrease, but there'll be more shares in general, so the value will stay the same. I don't know if that got translated well. It's much easier to see all together, honestly. Any questions on the valuation, cap table, or dilution of shares? Amazing.
Okay.
Look, honestly, in terms of fundraising and financing, it's going to be very different from company to company. It depends on your valuation, depends on your current shareholding or structure, and your valuation or the amount you're raising is also going to affect your dilution. So it's a whole package that you have to consider when looking at equity fundraising against debt fundraising.
Questions?
I know we've covered quite a few already, but if you have any more question, we only have 7 more minutes on our scheduled time, but of course, please feel free to reach out to us. These are our emails. If you feel like you want to take a little bit deeper and talk about your company's financials in details, or you have questions that are very specific to your company in terms of investment, please reach out to us. Marco is the investment specialist, as you could tell by the session. If there are more targeted towards finance, you can actually come to me as well. So if you guys don't have any more questions, it was super happy to, I'm very happy to do this session. Actually loved your questions and your comments. They were very fruitful and they made me think a few things as well from my side. So thank you for listening and for joining. I hope that you guys found this session fruitful, not boring, and you were able to take something out of it at least, because I know that a lot of you already had strong financial acumen. Maybe it was a good refresher if you haven't used that for a long time.
Perfect. Yeah.
Thank you so much.
Thank you so much.
Yeah, that was very helpful. Thank you.
All right. Do you want to take over?
Yeah, you can. If you leave, then I can do my mics.
I'm not leaving, but go take over.
Oh, okay.
It's you.
All right. Did you mute yourself?
No.
Okay. I'll go to you guys. Okay, everyone. So that's for today's session. Like I did with the last one yesterday, you received like a feedback form on this session. So I'll send that out after this, as well as the link as well. So this whole session was recorded just in case you want to go back in and see any bits of that information. We have another session again. We have 2 sessions tomorrow, one in the morning and one in the afternoon. So same thing again, it'll be on Zoom. But yeah, if anyone doesn't have any more questions or anything, and like Joanne and Marco said, they have their emails. If you're looking for anything in particular, they'd be more than happy to speak with you. But I want to also thank Joanne and Marco for their time, because it was a really great session. But yeah, we will let you guys get on with your day, and I'll see you all again tomorrow.
All right.
Thank you so
Good luck,
much.
everyone.
Thank you. Bye.
Bye-bye.
All right.